Good morning, everyone. Welcome to breakout session 8, which is affordable housing finance, hot topics in low-income housing tax credit, or what we call LIHTC equity. I'm Hilary Lopez from Praxis Consulting Group, and I'm excited to be joined today by this panel of experts, which includes Roy Faerber, Senior Vice President of Equity Production at Boston Financial, which is an equity syndicator, Aaron Krasnow, who's the Regional Director at RBC Community Investments, another equity syndicator, Jill Edwards Resnick at the end of the table, who's the Managing Director at Charles Schwab Bank, an equity investor, and then finally by Lorri Murphy, who's Vice President of Real Estate Development at Ovation Development, which is a Nevada affordable housing developer. And all of them will share their thoughts and insights on the state of the current LIHTC equity market. For those of you who've been here over the past 2 days, we've talked a lot about the need for more affordable housing. And one of the main tools that we use to finance these developments is the federal low-income housing tax credit. Developers who receive an allocation of either 9% competitive LIHTC or 4% non-competitive LIHTC in conjunction with their tax-exempt bond finance projects, in turn then sell those credits to an investor to raise money or the equity for their project. As we all know, equity markets, like other markets, are continuously in flux and are impacted by changes at the federal administration level, by federal legislation that's proposed or passed, by COVID and the pandemic that we've been in, as well as by other factors. At Praxis, as development finance consultants, we work with our clients to help them structure and assemble the financing that they need for their affordable housing projects. And one of the main items that we're continuously tracking as a result of that is the current pricing and trends in the equity market to help determine the impacts of those types of changes on the viability of projects, on the desirability of projects, and on the need for other gap financing that will help those projects move forward. So today we're going to discuss a variety of topics that impact these projects. And the first one that we're going to talk about is the one that everyone is always most interested in, which is what is the current pricing in the equity market and kind of what trends in pricing are we seeing? And to lead that discussion, I'm going to turn it over to Roy.
Hi, everyone. How you doing? Again, my name is Roy Faerber with Boston Financial. I like when we start off the equity panel with the closer, like what the pricing is per credit. It's normally the last question, but why not? Pricing is the good news is that pricing has been very stable, and I think it'll continue to be stable, at least for the foreseeable future. Now, there's a few caveats there that come with that. First, let me just rewind a little bit and let's think about what happened over the last year and how to show how resilient the equity markets are. We had the 4% credit go from a floating rate at anywhere around 3.15, 3.13, 3.16, all the way to 4%, and that effectively increased the amount of credits across the country by, I would estimate, by about 40% or more. 4% credits. And we also had large swaths of credits additionally hitting the market in states like California, which added $1 billion of credits last year and another $1 billion of credits this year, just in the 9% program to recover from the wildfires out there. So with all of those additional credits hitting the market, I feel, and I think most of us would agree, that the market's been pretty resilient in absorbing those credits. There's been a little bit of downward shifting in pricing in certain markets that are oversaturated, some of the California markets, for example, but in Nevada here locally, I'm still seeing tax credit pricing being very strong. So that's the good news. We were able to digest all of those additional credits in the market with the existing investors and some additional investors that we have. What happens going forward it is all going to depend on what happens with the tax reform. If we end up with one of the proposals, if many of you are following it, is to reduce the 50% test down to 25%. That's a request by the coalition to help get more out of the bond cap that we currently have, because that's a restricting component. A lot of states are oversubscribed, not just on the 9% credits, but also on the 4% credits. And that oversubscription, meaning more applications than awards are available, is due to the fact that the states don't have enough bond cap. Every deal needs to pass the 50% test, and every bond deal needs to pass the 50% test. If the test is lowered from 50 to 25, you need half the amount of bond cap to pass the test so states can then do more deals. So that would flood the market potentially with a lot more additional 4% credits. Also, as part of the current proposal that's being supported by the industry, is to increase the 9% credit by up to 50% of what's currently being allocated. While that all sounds great to us, and I think we would all be very happy to have that, we also have to realize that that could cause some downward pressure on pricing. More credits, it's just basic supply and demand. More credits hitting the market, investors are gonna, have a little more choice between which deals they pick, and they'll be able to effectively, in many occasions, pay less per credit. And then there are a few other things that could change pricing as well. There's some talk about changing the bonus depreciation, which would lower some immediate losses that we take that help our yield, which help give higher pricing. And there's also the discussion about raising the corporate tax rate from 21 to 24, 25, or 28. That would help investors, and that could help pricing. So you put all that in a big bowl and swirl it around, and you really don't know where we're going to end up. So we're sort of at a point now where we're very happy with how the market's been resilient. And depending on what happens with all these prospective changes, it could be a little bumpy next year until they're all digested.
And
how's that?
So it's good information. Can you also talk about, I know we're all kind of still longing for the good old days, which weren't that far behind us, of dollar plus pricing, and more recently we've seen pricing in kind of the higher 80s to low 90-cent range. And I don't know if you and Aaron can maybe kind of opine on, if you think that pricing will continue to go up as we come out of the pandemic, or if you anticipate that pricing will remain in that range for the near future. Like if I shook up my 8-ball and handed it down to you, but you couldn't say outlook not good, what would it say?
I would say that Roy, hit the nail on the head just in terms of the myriad of unknown factors that contribute to, LIHTC pricing. And there's, deal specific things, obviously. I mean, whenever I'm asked, what's current pricing for a deal, the answer is always, it depends. Where is it? How big is it? What do the benefits look like? Is the property located in an area where there's a lot of investors that have Community Reinvestment Act need? Is it a rural location? Are credits, available immediately because it's a tenant in place rehab, and there's a bunch of people that are already in the units and qualifying them so that there's immediate availability of credits. So I think, but generally to answer your question, I see stability going forward. I think the amounts that you just referenced, Roy did a great job about not throwing out pricing, but talking about the market. It does depend. It's like what I'm seeing on a 9% or a 4% deal, and I don't think there's as wide a gap between the pricing of those two types of transactions these days as maybe there was several years ago. If it's in a more populated, higher value CRA area with good sponsor, talking low 90s, right around 90, 91, 92, depending on distribution, to either a direct investor or a syndicator that has a proprietary investor that's got specific CRA need in that area, maybe down to the high 80s, I would say. If distribution is just, lower CRA value or no CRA value to an economic investor in a tertiary or rural market, you're probably talking about the low to mid 80s, frankly, I would say. And again, I mean, there are a number of items that, you know, are up in the air in terms of, you know, the availability of additional credits that may come into the market with, you know, the approval of the human infrastructure bill and sort of what, you know, stays in there. I think Roy made a really interesting point. You know, the 4% fixed rate, right, went from like 3.15 or 3.17 to 4%. And Roy said he saw an increase of, you know, 40% of 4% credits in the market. And those two don't necessarily equal one another. It's just because more credits meant more equity, so more deals made sense and could get done, and investors would invest in them because there weren't financing gaps. So, I mean, at this point, and over the last, you know, 6 or 8 months, I mean, I've seen more 4% deals than I ever have previously. That makes sense in markets that, you know, didn't make sense previously, just because they're, you know, the rents weren't there, and the more equity just, you know, makes those deals pencil a little bit more. But just to get back to your question too, and I think this is probably a good one for Jill to respond to, is, you know, what happened to the days of $1 or $1.15 pricing? And I mean, from a syndicator standpoint, you know, several years ago, the upper tier investor market started to focus very strongly on what's referred to as an upper tier price per credit. So as a syndicator, we are buying tax credits from developers, and we're paying you a certain price for those tax credits. And then on top of that, when we are transferring those tax credits to an upper tier investor like Charles Schwab Bank, you know, we are required to set up upper tier reserves. There's working capital. There is the fee that the syndicator is charging for the services that it is providing both to the developer client and to the investor client as well. So, you know, that's usually ends up being 5-6 cents or so. But at a point in time, upper tier investors decided to focus very strongly on sort of that upper tier price per credit number, and decided that it for whatever reason, that it shouldn't be above, say, $1 at the upper tier. It just didn't make sense to pay more than $1 for $1's benefit in tax credits, even though additional things go into an investor's return from, you know, a low-income housing tax credit investment. So, I mean, for that reason, and that just sort of spread throughout the investment community. I'm not, you know, certainly don't want to call out Charles Schwab, because I mean, they're just one of, you know, many upper tier investors, and they all sort of are taking the same approach in terms of being focused on limiting what they will pay at the upper tier, that upper tier price per credit. And it was, you know, 4 or 5 years ago, $1, sort of slipped to 99, 98, 96-ish right now, probably. So maybe Jill can respond to that a little bit.
Well, I can say Schwab is actually not, Schwab is an IRR investor. We really look at the internal rate of return that factors in the time value of money when you're paying in your capital, and not necessarily only the price per credit, although, you know, that is a factor always in a deal. We also derive a lot of benefit from the benefit of the losses. And when the corporate tax rate went down a few years ago, well, more than a few years ago now,
2016.
the value of those losses also went down. So in order to keep our returns at a level that was acceptable, we did go back to our syndicator partners. A lot of investors went back to the syndicators and say, you know, what are you going to do? And oftentimes that meant a decrease in what we call their load, the fees that Aaron was talking about. So, I mean, you know, as in any discussion around pricing, there's a lot that goes into it. But I'm not familiar with the, you know, investors like putting a cap on the upper tier price per credit necessarily, but that's interesting.
And I know we have a question in the back. We're gonna just try and get through the main topics and then come back to questions. Does that work, May? Sure. Okay, perfect. I just want to make sure that we have time to go through the items that we had pre-discussed. I think moving from pricing, another area that really impacts project viability and desirability is underwriting trends, as well as then whether there's investor appetite for certain types of projects. And so I think, Aaron, you were gonna spend a few minutes talking more about some of those topics.
Yeah, sure. So probably need a microphone. So I guess I would say that sort of there's a pendulum, I think, when it comes to underwriting in terms in the low-income housing tax credit market, and sometimes it's sort of swinging to the investor side, and sometimes it's swinging to the developer side. That's just been my experience in my 20 plus years in the market. And so when the pandemic hit, I would say, you know, most recently, I think the pendulum definitely sort of swung over to favor investors when it comes to certain, you know, underwriting standards. And that's, I think, primarily because, I mean, there's a lot of reasons. A number of tax credit investors at the start of the pandemic and probably 6 to 8 months into it just took a pause, you know, just stepped back and said, you know, we're just, nobody is sure what's going to happen here. So we're going to, you know, I think for the most part, probably 100% honor our existing commitments. But after that, we're just, you know, maybe not going to look anything new and sort of just see how everything, you know, plays out. And as there was, you know, fewer investors in the market, the investors sort of that remained were looking for more and more standardized terms, or sort of, you know, deals that were directly down the fairway, I guess, you know, is sort of a good way to put it, in terms of, you know, underwritten to a 7% vacancy and 6-month operating reserves, and guarantees that were capped at 6 months operating expenses, reserves, and debt service payments for a period of, you know, 5 years after stabilization of the property. These are sort of all pretty consistent terms, you know, working with, you know, good sponsors who have, you know, a strong balance sheet. And generally that's defined like for a 9% deal, you know, if you have $5 to $10 million in net worth and $1 million liquid, you know, generally, you know, a syndicator or an investor will invest in that transaction. I will say, but, you know, in addition, just to sort of there being less investors in the market and investors being able to be more selective, I mean, the way that we all worked changed dramatically with the pandemic, and sort of everybody moving from, you know, an office environment, a collaborative office environment where you can just walk down the hall and talk to the decision maker, you know, about a deviation or an exception to a certain underwriting standard, you know, you couldn't necessarily do as easily anymore. You know, some shops were set up from a technology standpoint to really be able to communicate and, you know, to keep cranking along. Some upper tier investors we worked with, you know, didn't miss a beat. They were great. They responded to questions, you know, or were able to make decisions quickly. Other investors, not so much. It's like they just faced sort of a lot of challenges from a cultural standpoint to be able to keep executing when they weren't working in an office setting. So I think for that reason, the industry sort of, you know, tried to compress or go back to a set of, you know, standard underwriting assumptions that may have been, you know, prevalent in the market and just sort of easier to get approved through their various internal committees and their chief credit officer. And then, you know, from a syndicator standpoint, our investors, you know, approval committees as well.
Can I ask, you know, one of the big issues right now are supply chain issues. And so for projects that are either looking to close in the near future, for example, how are you looking at and underwriting things like material purchases, storage of products?
I mean, I can say real quickly, and then I'm going to hand the mic to Lorri because she's probably going to have a lot better insight on supply chain issues and actually getting stuff done. I mean, we've required, I guess, a lot more discussion and conversation around where projects are in the bidding and buyout process. And so we've tried to do our best to understand, all right, are these costs that you are presenting us with based upon real and locked in numbers? And you can only do that to a certain degree. Like I've had deals where deal has been completely bid out. There is a GMP, the contract is executed, we close the deal. 2 days after we close the deal, a GC has provided a developer a change order for $1 million in increased lumber. It's like, there's just, you can't do anything about it. I mean, practically, a general contractor is going to charge you what it costs them to build the project. I mean, there's not a lot that you can do. I mean, 2 days after you close, you're probably not going to kick a general contractor off the job. You're just not going to find another general contractor who's going to be willing to sort of step into their shoes, frankly, at the same price. So you're sort of stuck with where you are. I mean, there has been an increased focus on critical path schedules as relates to items that we know about currently that are facing sort of supply chain issues. But it seems like every week it's something else. It's, paint. Right? You just can't, there's not paint, availability of paint. And you can't get a CO without paint, or appliances people have heard about. I've heard doors, but I'm sure there's a couple of other things. It's really just doing our best to have, an open conversation, not only with our developer partners, but with the general contractors and representatives from the general contractors. We get closer and closer to closing.
And Lorri, I was going to ask if you wanted to.
Yeah, thanks. Yeah, we've definitely been having issues with supply chain, and we just closed a deal recently, and it did come up. So first, I'll tell you the conversations we had with the investor and some of the things that we did. The cost and plans reviewer at first wanted a 7% contingency instead of a 5% contingency, which is the norm, to allow for the supply chain issues. And so we basically went through, that we've got this project pretty well bid out. And we actually took kind of an extraordinary step because we're a very conservative developer. And we also are, we're also our own GC. And we locked lumber so that, because lumber is the biggest swing, you're right, there's a lot of different commodities that are increasing, but the biggest dollars is in lumber. So we actually locked our lumber pricing in early. We had to pay upfront deposits for it. And it turned out we locked it at the peak of the market.
And you probably only found a subcontractor or two that would have allowed you to do that. Right? I've had some clients who said, we're trying to lock in lumber, but our subs are just telling us you'll pay what it costs when it gets put on the truck. That we just can't, can't do it otherwise.
You're right. It was very difficult because they didn't even know how to lock it. I mean, it's just, this is all something new. And so we have really strong relationships with our subs, which helped. And we were able to do it. And even though we locked it at the peak of the market, it made our investor more comfortable and made our owner more comfortable, because for us, the biggest problem is uncertainty, and it gave us a high level of certainty. That and the fact that we had, we were pretty far in our bidding process, and we have a very good track record in the past. We were able to keep the contingency down to 5%. But we did update our bids right before we closed, and there were a number of subcontractors who came to us with increases, and we actually changed our budget. We increased our budget right before we closed, and luckily the economics of the deal made it work, so there was still enough. We just reduced the paid developer fee and deferred a little more, and so it still worked. But yes, it's definitely an issue.
And Can I ask, just staying on the underwriting topic for a little bit, at Praxis, we work with experienced developers like Ovation, but we also have some newer developers. And I know that there are some who are in this room that are just looking at whether or not they want to dip their toe in this LIHTC pool, especially as we get more resources and try and build capacity within our state. What advice would you give right now to first-time developers, or how are they vetted through your process? Like, what are investors looking for when you're reviewing a proposal from a first-time developer? So, Roy, I don't know if you want to.
Sure. That's a great question. We need new developers to come into the industry. It's very important. However, investors do look a little skeptically at a developer that doesn't have a lot of experience. So to the extent you can, bring on someone who has a good amount of experience or joint venture with a shop that has good LIHTC experience, that would be very comforting to an investor, because there's a litany of things that can go wrong on these deals. And the more experience the developer has, generally speaking, the more they'll be aware of what to look out for. I would also recommend hiring, if you're a first-time developer, hiring a firm similar to Praxis, because they can help you with not only the application process, but also hiring and engaging with a good general contractor, an experienced architect, the right management firm, who your debt and equity would be, and help you vet all those issues and give you a heads up on what to look out for throughout the process. So I would encourage anyone here who's a new developer to get into the game. It's very rewarding. You can make a little bit of money and you can help people. So I think it's a great industry to be in.
And just finally on underwriting, recently the code was changed to allow for income averaging at projects. So you no longer just had to decide between the irrevocable set aside of having at least 20% of your units restricted at 50% of area income, or 40% at 60% of area income. And the income averaging allows us to go up to 80% and provide units for a broader segment of the population. But unfortunately, the IRS guidance that came out, I know, has some issues that have made it difficult to actually implement income averaging. Are there any thoughts, or can you just give some information on kind of where your organization or company is, or where investors are in terms of looking at income averaging or moving forward with it?
At RBC, we're not looking at new deals with income averaging right now. I mean, and that's because we're just not able to place them in the market with either proprietary investors or investors that are investing in our multi-investor national funds. And that is because of the most recent IRS guidance. I know that there was an open forum ability to submit comments sort of on that guidance that the IRS put out, and I think that was back in March or April of this year. Yeah. And everybody submitted comments saying, your guidance is not consistent with what the industry understood compliance to be around these average income units. And the IRS said, thank you very much for your input. We will respond. And there's been crickets. I mean, they haven't said anything. So maybe they'll respond someday. And if they do, it probably will not include everything that the investor community and the syndicator community, the developer community, want or need it to be. But at present, we're just not entertaining deals with income averaging at all. And that's even if you put in sort of stop gaps, like if 40% cushion to 60% AMI, we're still not looking at it, unfortunately. Restrictions in the partnership agreement, to renting to 60% AMI and still checking the income averaging set aside box. We're just not doing that either. So we're having a lot of discussions with developer clients that have gotten initial reservations based upon a presumed average income set aside, and they're having to rework their deals and go back to housing finance agencies to get their approval to move forward with a reworked deal based upon a 40 at 60 set aside.
Oh, great, Jill.
Yeah, so I'm going to talk before Roy. I'll also tell you everything I was probably going to tell you anyway. So I will say it's nice to hear that we have a more conservative syndicator than maybe we are. I always thought we were the most conservative investor out there, but I will say we have a similar outlook on average income. I mean, the rules as proposed are unworkable. We're hoping that eventually they will change, but there's no movement to change them right now. So we did also close a number of average income deals that were in the pipeline, too, with Boston Financial actually, but we had to go back and renegotiate the deal terms on those 2 deals. One of them actually had no cushion to the 60% average income. So we went back and we added in a cushion. So they had to shift around the unit designations. They had to bring some 80% units down to 70% of AMI. We also required an additional and personal guarantee from the developer, as opposed to solely a corporate guarantee. And we put in language that requires a compliance check annually, as opposed to just at initial qualified occupancy. So every year, within the first 10 days of the new year, there has to be a third party. So this is like probably the 4th or 5th level of compliance check on this deal, but we required a third party compliance firm to verify that that the units qualified and that the tenant's income was correct, and that everything was in order, because you really just, under the proposed rules or under the current rules, you don't have much of a cushion to go back and fix any issues. You only have 60 days. So I will say we are still considering average income deals, but only if they are structured extremely conservatively, with not only a percentage cushion to the 60% AMI test, but an actual unit number, like a unit count. So if you've got a small project, maybe the unit count is 2 units, but if you've got a large project, it could be 10 or 15 or 20 units that we want to see, could go out of compliance and the project would still stay under that average income. I don't know if that was too technical, but
No, I think that was great, very helpful. And I think, Roy, I don't know if you wanted to just add
just going to say the exact same thing they both said, except that without getting redundant, we are looking at them on a case-by-case basis, but they do need to be underwritten well with plenty of cushion, with a good sponsor. It also helps if the management company that's involved in the deal is very experienced and very buttoned down. Any facts we can give, any facts we can provide to both the investor, the underwriter, and ourselves internally, our own internal committee. The more facts you have, the better. The more good facts you have.
But most investors are saying no. Some investors are saying maybe under certain circumstances, but that's like 10% investors.
Yeah, it's definitely a. I don't want anyone to walk away with the impression that they should go out and run out and do a income averaging deal today. But if you have one, you do need to talk to probably a lot more people than you normally would to try and make sure you can get it done, especially before you outlay a lot of money for the transaction.
Yeah, I do think, though, that moving forward, it's an important point. Actually, just that way, it's an important point for the industry to keep working on, because it really does expand the segment of population. And we know that folks between 60 and 80 could also benefit from
it is
these
great
units.
from a demand standpoint. It's great for preserving housing where you have existing tenants that might be a little bit over income. It's great for rural communities, right, where there's just not a lot of people at 60% AMI. There's people at 80 and there's people at 40, but it's that sort of narrow income band right around 60 has always been hard from a demand capture rate standpoint. So it really expands the pool of qualified households, and I think serves a real need. So I think the intention of the set aside was great. And I know that the industry, everybody out there put a lot of work probably into educating housing finance agencies too about it and getting them comfortable. And then right when they did, the IRS issued this guidance that made everybody go, whoa.
So, well, and just kind of talking about the federal level, I think Jill was going to spend a few minutes kind of talking more about some of the federal changes that we heard about earlier this morning, and then a few items of that may be of particular interest in terms of the equity market and LIHTC transactions.
Yeah, so I'm sorry, but I missed Stockton. I think it was Stockton who gave an update this morning. But I have been talking with Emily Caddick at the Affordable Housing Tax Credit Coalition. And so I think probably many of you saw the president's announcement this morning about the Build Back Better human infrastructure side of the plan. Nothing has been finalized yet, as far as I understand. But the $330 billion that were in the House bill was reduced to, I think, 150 billion. So, I mean, it's about half of what was in the original bill. And those housing provisions that are still in the plan as of this morning are all of the sort of the big housing initiatives, public housing and vouchers and things like that, which is good. We want those things to still be in the bill, but what is not in the bill right now are any of the provisions around the housing credit. So that is still to be determined. It doesn't mean that they're out. They're just not in right now. But the tax component of the bill has not been negotiated yet. So that is still to come. I think there's still a lot of optimism that a number of the provisions that Roy talked about earlier, the 50% expansion of the tax credit over 4 years, because as you may recall, the original expansion of the tax credit was 12.5% per year over 4 years. That's going to expire, is it the end of this year? Mm-hmm. So we really do need that. If we don't get that, we're going to see effectively a reduction in the amount of housing we can produce. Also, lowering the 50% test to 25% test is really, it just makes so much sense. There are a lot of bond deals that don't need that much bond financing for the project, for the scope of work. And so if you reduce it to 25%, you can effectively probably double the amount, maybe not double, but certainly increase dramatically the amount of bond deals that can get done. There are a lot of states that have hit their bond caps. I know Nevada has not yet, but could soon is my understanding. So that would really help this state as well. There are also some other provisions in the tax credit Improvement Act side of the plan that would boost the basis for not only deals that are in qualified census tracts or difficult to develop areas, but also for there would be a special boost for rural communities, Native American communities, and extremely low income tracts. And then there would be another discretionary boost for 4% bond deals that where states could just decide we want to boost these credits, and that would also really help. Again, we just don't know what's going to be in there. There's some other things in the bill too around right of first refusal, changing some of those rules. I'm hoping that that can get done because I don't think that really costs anything. So I guess, the time will tell. I mean, hopefully we'll know more soon. I think the president said he's gonna know more when he gets back from Europe. So he's got more pressing issues right now, but I think maybe by next week we should have a little more clarity, especially on some of the holdouts. So if anybody's still talking to their senators and representatives, please continue to advocate. I'm not allowed, but others can.
Thank you. And then I just want to make sure before we move to questions that we have some time for Lorri to kind of add her perspective as a developer about the impacts of some of the recent market changes, as well as how some of the new resources that we've been talking about over the past couple of days in the earlier session on the state tax credit, as well as with American Rescue Plan funds, will impact the ability to create new units in Nevada.
Yeah, thanks. Well, first, talking about the legislative impacts, some of the things that Jill just described would be huge. I understand that increasing the supply might put pressure on the pricing, but we are getting ready to, the 4% fixed did make a lot of deals more viable. The ARPA funds that are coming to the state are going to make a lot more bond deals viable. And so now the constraining factor might be what they call the volume cap, which is the amount of tax exempt bonds. So, the other thing that, that one, the two things that really speak to that are the reduction in the test from 50% to 25%, and also the increase in the allocation on the 9% credits. The other thing that would be huge for us is the boost, because in Nevada, I don't know about other areas, but we have very few zip codes that are in what they call a small area DDA. And that small area DDA increases your equity amount by 30% just because of the zip code. And that makes a lot of deals either easier to pencil, or if they work and you have soft funds, you can target deeper, you can cover cost increases. There's a lot you can do with that extra 30% of equity, and it doesn't cost the state anything. So those two things would be huge. And since I'm still talking about the ARP, the funds that are coming to the state will be game changers. We're thinking what we'd like to see happen is to be able to use a lot of those funds as gap financing for bond deals especially, and that would allow either making some deals that weren't feasible, or allow you to target more deeply, or allow deals that all of a sudden are experiencing cost increases and might no longer be viable to kind of cover those. So those legislative changes would be huge. In terms of the pricing, it has been stable. And I'm going to be honest, we are a very experienced, kind of sought after sponsor. And so we get top pricing, but it still did come down recently when the 4% fixed legislation passed. But to give you an idea, the impact of 1 cent decrease in pricing on some of our recent deals is around $200,000. And those are larger bond deals with high cost. A 200 unit project that we just closed would have reduced the equity by $200,000 just for 1 cent in pricing. So that just kind of gives you an idea. Smaller deals might be a little less, more like $100,000, but it's still a big impact. Some of the other things that are changing besides the federal legislation is we have this state tax credit, which is another source of gap financing that is going to be very helpful. Again, just like the ARP funds, we'll be able to contribute soft financing gap dollars that will allow us to either target deeply or do projects that would otherwise not have been done. And to give you an idea, we have a project that we've been working on for a long time where we were able to reduce 80 units. It's a 200 unit senior project. And we originally had it in at mostly 60% AMI with 20 units set aside at 30% AMI. And by putting some more soft dollars in, we were able to add 80 units or that at 50%. So reduce 80 of those units from 60 to 50%. And we did some math. It depends on the cost of your project, but anywhere between $30,000 to $50,000 per unit will reduce one unit by about 10% in AMI. So that's a big impact. I kind of already talked about the legislation that would really help us. Underwriting changes that we would wish list, underwriting changes. We always do 40% amortization, and I'm hearing that that's more normal. That's great to hear. We also underwrite at 115 debt service coverage. I don't know, how the investors feel about that. We also look for 3 months operating reserve. We're a little more aggressive. 5% vacancy in this market, especially when we're doing senior projects. So some of the things that cause us issues sometimes that we wish we could do better. The trending lately has been very conservative. That's one area we've really seen our investors be more conservative. They're still leaving that 3% operating expense increase, even though we haven't hit it for the past 15 or 20 years. But they're reducing our income increases. We're not seeing it. It used to be the standard was 2% for rents and 3% for expense. Lately, they've been a lot more conservative on your rental increases. And sometimes that, because they want to see the 115 debt service coverage throughout the life of the project. And sometimes you end up
Negative trending.
Right, with negative trending, which causes a little, makes it a little tougher to size the permanent loan. And then, the other thing, our investors are very conservative when it comes to expenses per unit, per annual operating expenses. We've had this conversation for years. We always wish they'd be a little less conservative. But that said, all of those things make the deal safer for everybody. So if we can make it pencil and it still underwrites, it just makes it safer for the investor and the developer. And then we have more cash flow if we beat our projections, which we always do. So I think that's it. There were.
Awesome.
I did. The only thing I did want to say, when you were talking about what investors are looking for developers, I did want to kind of expand just a little bit on the things that make it difficult for developers, especially if you're not. Developing is difficult anyway, but even more difficult in low-income housing because of all the regulations and the layering, and it's just very complex. But things to keep in mind if you're considering, there's a lot of upfront investment. You've got to buy the land or take out a land loan. There's and also you have architectural and engineer costs, entitlement fees, a lot of upfront investment, and you've got to be ready to take over. The time lines are very long. We've got one deal that we've already been working on for 2 years, and we've probably got another year and a half before we break ground. And they're hard to pin down sometimes. So there's a lot of uncertainty. It's hard to staff up, to know how to staff up. because you don't know how many projects you're going to have, because you don't know when things are going to fall. So just kind of wanted to point that out, that those are things you need to keep in mind.
Thank you. I want to leave some time for questions. And I know, May, you had a question from our online audience.
Yes. Sorry, feedback. Yes, so the question is, would a minimum corporate tax under Build Back Better affect pricing?
And I don't know, Roy or Aaron or Jill, if wants to take that.
I don't think so. Yeah, it's hard to tell. Our current investors are, have a 21% corporate tax rate, and we're able to project everything on that. If what you're saying is they would have a minimum, let's think about that. If there would be a floor of, say, 15%, maybe that would take some of the fear out of some investors that in a given year they would have less liability, so they wouldn't have a need for the credit. Maybe there could be a theory there. I don't know how direct that would be. Do you have any other thoughts on that?
I mean, I think the current proposed minimum 15% tax rate like impacts 200 companies in the United States, something like that. So it's like 300. So you need to match up, which companies that are investors in tax credits sort of fall under the impact of that minimum tax rate. And then you need to go deeper into that, like what types of credits, or can you use any sort of credits to offset that minimum tax as well? So I think this was a proposal that was floated a while ago that was dismissed. And then when it became clear that certain moderate Democrats wouldn't approve any increase to the corporate tax rate, the administration and both parties sort of have gone back to it. But I don't think that there's been enough technical discussion or analysis to determine whether it would have any impact whatsoever or what it would really look like.
Yeah, I was just going to add that I do think that the housing credit can still be used even with a minimum corporate tax rate. I know in some cases certain credits couldn't be used, but I believe that they can or would be able to be. But again, we don't know enough about that.
How about questions in the room? There are questions from those in the in-person audience? No, I think there's one.
So you talk about the complexity of getting the loan, layering the loan, things of that nature. Let's say we have a newer developer that has never done this before. Would there be like a place where they can pull information to say, okay, this is kind of the path ahead of me, the road ahead, or would it be just speaking specifically to, a lender or things of that nature?
Yeah, I mean, I think, talking to people who are in the industry, considering hiring a consultant like Praxis for sure, is going to help you navigate, through the environment in the industry of low-income housing tax credits. I've had, the benefit of working with a lot of first-time low-income housing tax credit developers who weren't new to the real estate development business. They're generally market rate developers who got into affordable development. And the best ones really took their time to sort of figure out, how the space worked and what they were getting into. And it was through going to conferences like this and attending sessions like this and going to the big Novogradac conference that's in Las Vegas every year to learn about tax credit basics and affordable housing development basics. I think, everyone probably up on this panel and throughout the industry is very approachable. And we want to support new entrants into the low-income housing tax credit development community because it, ultimately means more business for us with good partners. So I think we're great resources for not only up-to-date market information for experienced developers, but probably some technical assistance for less experienced developers.
Yeah, and I think just what Aaron was saying, we're always happy to talk with new developers about LIHTC and the LIHTC process. Lorri and I were also recently on a panel with AIA Las Vegas with the American Institute of Architects, talking to that group about kind of their role in tax credit projects, as well as other issues and impacts on tax credit projects. And so I think it's helpful not only for the developer, but for others that are part of this broader development team to understand kind of the process once a reservation is received and kind of how we proceed through all of the steps to get to financial closing and then into construction. So it's great to see that there are other segments of the development team that are reaching out to try and learn more about our industry as well. But definitely, talking to those who are working in the industry, taking part now with the move, one of the, I think, positive things about the pandemic has been that there are a lot more virtual opportunities to receive training from different sources. And so it's not as cost prohibitive, especially for smaller groups, to get to a conference or go to a training. So I think that's been a positive as well.
Yeah, I just wanted to say, first, we work with Praxis, and they were definitely part of our education in the very beginning, and we still use them. They're also a big help. But when we were new to the industry, we basically went to every single conference that came around. And the Novogradac conference, I'm not going to probably do the basics 101 anymore, but I'm going to do that year 15 again. I've already done because there's always something new coming up in the industry. And I don't just go to one conference. I go to over and over and over again. And I don't know if you noticed, even in this panel, I was taking notes. There's always more to learn, and you just basically have to be willing to spend the time and take advantage of the resources.
We have an online question.
Yes. Okay, this is a little long. Yes or no? Are Boston Financial, RBC, and Schwab Bank supporting the fixes to the ROFR and the qualified contract as supported by NLIHC, NCSHA, and others?
And just before we get a response, just for those who may not be as familiar with that acronym, the RORF is the right of first refusal, which comes into effect at the end of the transaction. It's one of the ways that a nonprofit group could purchase the property when the investor is exiting. And NCSHA is the National Council of State Housing Finance Agencies. It's like an umbrella group that represents state housing finance agencies across the country. So, and with that, I'll turn.
Yeah, and also the ROFR, it's called right of first refusal, ROFR, as well as the second item I think you mentioned was the qualified contract. Those are both. There are some flaws in the current language that's out there, and Boston Financial is very supportive. I think it's Senator Wyden who's proposing those changes, and we are. I imagine you guys are as well.
Easy, yes.
Yes, for sure, the new the proposal that's out now is to actually have put language in the documents and take out this concept of right of first refusal altogether, is my understanding. So that would greatly improve the whole process at the back end, and take out all of the uncertainty that's currently there, that's been creating problems.
Or to make the ROFR look more like a purchase option, not to require a bona fide third-party offer.
And with that in mind, what we're doing is we're building into our current deals language that anticipates a change and allowing it to automatically apply to the documents as they're currently constructed. That way you don't have to go back and amend them. So we're actually taking a proactive step to help make that, if the language and the legislation does change, just have it roll through our deals without having to change anything.
I think we have a question in the back.
Thanks. I have a couple of questions about the development underwriting assumptions. First, you mentioned that you're underwriting some deals below 2% income or revenue increases. And so I was curious kind of what that looked like. And then on the deals where you are doing 3 months of operating deficit reserve coverage, are you then filling that in with additional operating deficit guarantee coverage, or are investors accepting less than 12 months combined?
So I'm holding the microphone. I have not underwritten deals with less than a 2% income trending. There's a couple of deals where we're doing right now where the anticipated rent growth for 2021 or 2022, or the market is not supportive currently of collections in the developer's portfolio that warrant us to make that assumption. So what we're doing is on a couple of deals, we're assuming in year one, in this case, if we're closing today, 2022 would be year one, we're assuming a 0% trend in our underwriting, but then starting the 2% trending again in 2023 and 2024. And then on those deals, we're allowing the developer to size up based on actual rents. So it's just a short-term underwriting projection that's, limiting the debt sizing. But once the deal converts, we're allowing them, based on actual rents collected, to size to whatever debt that they can size. And then with regard to your question on the 3-month operating reserve, yes, it's exactly what we're doing. If we agree to a 3-month operating reserve in the development budget, we're offsetting that with a 9-month operating deficit guarantee to get the investor back to 12 months. So,
And I don't know, Jill or Aaron, if you have anything you want to add?
Yeah, I mean, I would say we look at things similar. I mean, to the, in the instances where we are allowing less than a 6-month operating reserve, which is on a case-by-case basis, limited to, premier sponsors, good markets, obviously. Developers are usually willing to accept an increased operating deficit guarantee cap, not a huge deal. So, I mean, we try to get it, sometimes we're not successful, I guess, and you have less than a combined 12 months. And I would agree. I mean, I'm not underwriting on a base assumption case to a less than 2% inflation factor, but we sensitize the hell out of stuff, right? We run sensitivities to high heaven. So, I mean, we look at, multiple different possibilities. And I think Roy made a great point about, we ask for your, real estate owned schedule and certain, COVID specific rent collection, recent experiences for a reason. It sort of all goes into how we're underwriting, those assumptions.
I will say we have been successful during COVID, especially in California, where almost every deal had what became a standard 3-month operating deficit reserve. We were successful over the last year or so, getting that up to 6 months of operating expenses, reserves, and debt service, which gave us more comfort. We would, though, like Roy and Aaron said, we would allow operating deficit guarantee to increase to kind of make up for the difference in the operating deficit reserve. But obviously only with sponsors who could support that operating deficit reserve.
It's funny. I actually have a funny story. I mean, it's like all developers hate reserves because, the money isn't, you're not able to put it to work. It's just sitting there. So, I mean, we get that, but there was a developer, major developer in the industry, came to us at the beginning of the pandemic and just said, hey, we want the unilateral right to draw down on all project reserves, operating reserves, replacement reserves, whatever we want, because we, feel like this is just going to be a disaster and we don't want to, you guys to stop us. Or they basically said, we're going to do this. And, ultimately they didn't have to. And our response was, we'll work with you. We're your partner. We don't want these deals to fail. Decisions will obviously be made on a case-by-case basis. But I mean, there are unforeseen things that happen, and it seems like those unforeseen things are happening more frequently now than ever before. So I mean, reserves are our cushion in the deal, and developers have acknowledged, especially during this most recent 12 to 18 to 24 months, that sometimes cushion is needed.
Lorri, did you want to?
Yeah, I was just going to say, one thing, I guess it might be more specific to Nevada, but we did have some really large rent increases in the last couple of years. So that might have entered into the calculation, and, not wanting to use the 2% increases. But the other thing, it is each investor has a different way of looking at deals. And the particular investor that we've been working with recently is very conservative and is looking for safety over yield. And so for that reason, this particular investor would rather pay a little more in pricing and be a little more conservative in underwriting. And again, what we're looking at is, are we getting enough of our developer fee paid? Does the deal pencil? And if we can if we can make a deal pencil and have it be safer for everybody, we're happy. So,
just kind of changing the topic a little bit, our coalition has done a great job of assembling a stakeholder group to look at the American Rescue Plan funds that may be coming to Nevada, and we've developed a very bold ask to the governor and the state treasurer for a portion of those funds to support affordable housing. And we've kind of aligned it into different buckets of funding, some of which would go towards preservation, other towards new construction, permanent supportive housing. Are you seeing with the investors that you're working with, do they have certain preferences for new construction versus acquisition rehab projects at this point in the market? What's the experience there?
For my investors, no. I have a couple of investors that have quirky, they want senior rehabs right now. That's just what they want. But for the most part, no. The only caveat to that is leverage. We haven't really talked about that. There are a number of investors that have a dislike for leverage. But what I mean by leverage is how much total hard debt, must pay hard debt, is in the capital stack. So as soon as you start getting above 40 or 50%, these deals become harder to place. Investors, for whatever reason, view those as much riskier, even if it's an existing affordable housing project with project-based Section 8 contract that's fully occupied and you're about to do a $50,000 unit hard cost rehab. They think that that deal is a higher risk than a new construction deal in a market that may not be able to even fill the units. So that's just the reality of where we are because of leverage. The perceived risk associated with higher debt deals can and will impact some of investors' decisions to invest. So when you say new versus rehab, often an acquisition rehab deal, especially if it's coming out of a developer's portfolio, or if they have to go pay top, really any deal, ac rehab, if you're going out and paying top of the market price for a deal in the market today, you're going to often have leverage in the 60% plus range. And when I say that, I mean, if you look at your total sources, what percentage of your total sources is your hard debt? And if it's 60% or 65%, those deals are going to be harder to place. So the answer is yes, potentially. Rehabs, may not be as marketable and desirable because of the fact that they may have more leverage.
Jill, did you want to comment on that?
I mean, in this time of COVID, I would say that a new construction deal that's not coming online for 2 more years may be a little bit more favorable because you'll know when you're leasing up that property that the tenants can afford the rent. As opposed to a rehab, an unsubsidized and non-senior rehab, just a straight up unsubsidized family rehab, you risk, that some portion of the existing tenants cannot afford the rent or can no longer afford the rent. So that is also like a question that's a case by case basis. We didn't really talk about AMI. We did talk about AMI trending in terms of like the underwriting, but like what are we actually seeing given COVID? We're not going to see a decline in income for our tenant population. I mean, maybe we're not going to see a decline in income, overall in the overall market, but I think for our tenant population, we have to consider that there is going to be a decline. It's not going to probably, hit any data for 3 or 4 years from now. But we do think about that, and like Aaron was saying, we stress the heck out of our deals as well. And I know all the investors do. This is what investors are talking about right now, though, is what's going to happen with income trending. How do we look at it? How do we underwrite it? We obviously don't want to be too conservative, but we want to understand what our potential risks are.
Well, and I know, and Lorri, I'll give you a second, but I know we're at the end of our time, so we're a little over. So Lorri, I want to give you a chance to just kind of add your thoughts, but also, I think that what we've heard over the last 2 days at the same time that we're talking about some of the challenges is that there's a lot of opportunity in our industry, and that's great news. And so I do want to kind of end on a positive note of like very quickly just hearing what it is that you're most optimistic about for our industry over the next 2 to 5 years. So Lorri, I don't know if you just want to finish on this topic and then roll right into that.
Well, I was going to ask a question, but I'll just make a comment, because one thing that has happened during COVID is that we've been keeping our rents flat. Until the eviction moratorium stopped, we kept our rents flat. And even now that it's been lifted, we're not increasing them as much as we can. So I was going to ask how that's going to impact. The investors thought it was going to impact like when permanent loan conversions, but it's just something that we're kind of watching. But in terms of the optimism, the fact even already, we have in Nevada, we've had the GAP program, which has been a game changer for bond deals. The 4% fixed was a game changer for bond deals. And now you bring in more soft money, either through the state tax credits or the ARP funds, and all of a sudden we can have these 200 unit bond properties. We can start targeting deeper, and we can start having a way to serve the lower income population. And so there's a lot of work to be done, but we've got more opportunity than ever, and it's really exciting.
Great. Anyone else?
Yeah. I was just going to say, this is a great time. This is an incredible time to be an affordable housing developer or consultant or investor. There are more deals that are penciling, coming together well. We have very low interest rates. We've got the boost of the 4% fixed. We're seeing deals 200, 300. I closed a 420 unit deal last week, new construction. So it's a great time to be an affordable housing industry member. So I do want you to walk away with optimism. It's a really good time to be in the business. So,
Aaron or Jill?
I would definitely agree. I mean, I think we spend a lot of time on these panels just, talking about the hot buttons and, some negatives come out. But I mean, the fact of the matter is, RBC has raised and is closing $1.3 billion in tax credit equity this year, which is, its best year ever. Last year was its best year ever to that date, with the consolidation of Boston Financial and Boston Capital. I mean, just a huge player. You guys are going to have an amazing year. So we continue to work together collaboratively to get it done. I think we're a solutions-oriented industry, and that's proven out. We understand the need is great, and it's wonderful just to hear housing be in the national and state and federal dialogue right now. Everybody's talking about it. Everybody sees it. as an important issue. And I think is looking to everyone in this room, to be leaders in the space and to solve that problem. Also, I'm super happy to be out and been seeing people face to face.
Yes.
It's wonderful, even with wearing masks and getting to see real estate again, which is, we sort of think that we're just investing in tax credits, but we're really investing in real estate. And it's so meaningful to sort of be on the ground and to see, what true community impacts these real estate projects have.
Yeah, I will echo everything that you all said. I mean, to know that housing was in President Biden's plan at a really big number was so encouraging. And that says a lot for all of the advocacy. I would say that 3 trends I saw at this conference, which give me a lot of hope, were all the discussions around racial equity and just building more equitable communities. There's such a strong focus on that right now. We need to capitalize on that. We need to make sure that it's not just a fleeting trend, that this is here to stay, and we really make a concerted effort to do much better than we have done in the past. The second, there were a lot of discussions and panels around supportive housing. That was really exciting to see in a state that didn't always necessarily have such a focus on supportive housing or the resources necessarily. So hopefully as that conversation continues, you'll get more resources here in Nevada or for supportive housing, for the services, not just the construction of the units, that those two go hand in hand. And I'd say the third thing is focus on home ownership. It's not something we talk about a lot. On our side of the business, we invest in low-income housing tax credits, which are affordable rental properties. We don't often talk about home ownership, but I'm hoping that dialogue changes. And that, we talked about racial equity, and my colleague Alvin Odom told me a couple of years ago, he talked about this on a panel. The only way to build wealth the major way to build wealth is to own your own home. And if you can't do that, we're never gonna get to a place where we have an equitable community. So that was encouraging as well. So I think those 3 trends we need to really keep pushing.
Well, on those positive notes, I just want to thank our panel again. I know that now there's a box lunch across the way in the main area, but I think our panelists are probably going to hang around for a moment or two if someone has a burning question that you weren't able to ask or you just want to introduce yourself. But otherwise, please join me in thanking them, and we appreciate the time.